Welcome back to another episode of A Better Way of Earning. I'm your host, Dr. Michelle S. Thomas, and let's start with a simple question today. What happens to the money you earn after you receive it? For most people, income follows a predictable path. It covers housing, transportation, food, insurance, debt, and everyday living expenses. And whatever remains may go into savings. But here's the challenge: savings protects money, investing grows it. According to long-term historical data from the S&P 500, the US stock market has averaged roughly 9 to 10% annual returns over the past century, despite wars, recessions, political transitions, and global disruptions. The lesson is not that markets are perfect. The lesson is that time and participation matters. Today, we're going to remove the mystery around investing and focus on practical understanding. Before we get in today's conversation, I want to introduce you to something that is redefining how we think about work, opportunity, and earning. I want to introduce you to Ascent Global, platform designed for today's professionals, where your skills, your experiences, and how you actually work take center stage. Because the future of earning isn't about fitting into a system. It is about finding one that finally fits you. Visit ascent.com and experience a better way of earning. That is AECEN, D as in dog, T as in Tom.com. Ascent. The platform with the unique name delivering the future of how we work. Build your profile, share with your friends and family, and begin to experience a better way of earning. Visit ascent.com today. One of the biggest misconceptions about investing is that it requires large amounts of money. In reality, modern investing platforms have lowered the barrier dramatically. Many accounts now allow individuals to begin investing with as little as $10 to $50 per month. The greater barrier is not money, it is knowledge. According to a FINRA financial literacy study, only about 1/3 of adults in the United States can correctly answer basic financial literacy questions. That doesn't challenge our intelligence. It doesn't reflect anything about what we know about money. It is about how in debt our education, our access, our training is to true financial literacy. That gap creates hesitation, and hesitation often leads to missed opportunities. Let's simplify investing into three foundational concepts. Tool number one: the ownership principle. When you invest in a company through stocks, you're purchasing partial ownership. That means your financial future becomes connected to the long term success of said company. You're no longer only earning through labor, you're earning through ownership. When most people hear the word investing, they immediately think of the stock market. But ownership today has expanded far beyond traditional stocks. One of the fastest growing areas in modern investing is crowdfunding platforms. So, what are they? Crowdfunding platforms are digital spaces where individuals can invest smaller amounts of money into businesses, startups, real estate projects, or ventures that were traditionally only accessible to large investors or institutions. Instead of needing thousands or millions of dollars, people now can participate with smaller contributions, sometimes as low as $50 or $100. Here's how they typically work. A company or project is listed on a platform. The opportunity is presented with details about the business, risk, and potential return. Individuals choose whether they want to invest, and if the project succeeds, investors may receive returns based on the structure of the investment. Now, let's address the question many people quietly ask: is this real investing or is this risky? The answer is it can be both. Crowdfunding is a legitimate form of investing that has been growing globally, especially after regulatory changes like the Jobs Act, which opened the door for everyday individuals to invest in early stage companies. However, these opportunities often carry higher risk than traditional investments. Not every company succeeds. Not every investment returns a profit. So the principle here is not to rush in. The principle is to understand ownership today is more accessible than ever before, but access must be paired with awareness. And here's where a better way of earning wants to help. If you are one of those startup companies or businesses or real estate projects or ventures, and you would like to share your information and highlights with our global audience, head over to jobhuntchronicles.blog and complete our form to have your company or startup showcased in our emerging companies section so that we can help share your launch and your growth with our global audiences. That's jobhuntchronicles.blog. Let's move on to tool number 2, the compound growth effect. Albert Einstein reportedly referred to compound interest as the eighth wonder of the world. Here's why. If someone invests $200 per month consistently over 30 years with a moderate return rate, the total investment may grow into hundreds of thousands of dollars, not because of one large deposit, but because of consistency. Now, let's bring this down to real life. First, for my more seniored listeners out there, I know the first thought comes in, well, I don't have 30 years to wait for compound growth. It doesn't mean that you cannot start this at any stage of life. Any level of investment that you consistently invest into with that simple return can compound over whatever the time frame is: 10 years, 5 years, 20 years, 30 years, etc. Compound growth simply means your money earns money, and that money also earns money. Over time, this creates a snowball effect. Here's a simple example. If you gave $200 a month and invested it consistently over time, in the beginning, growth feels slow. After a few years, you begin to see progress. After a decade or more, the growth becomes significantly more noticeable. This is where many people get discouraged because in the early stages, it doesn't feel like anything is happening. But compound growth is not designed for immediate gratification. It is designed for long term stability and expansion. Think of it like this: if you plant a tree today, you don't expect shade tomorrow. But if you care for it consistently, over time, it becomes something that supports you. This, my friends, is how investing works. Consistency matters more than intensity. Tool number three, risk versus time. Many people fear market volatility, but historically, long term investors who stay invested through cycles tend to outperform those who attempt to time markets. Volatility is normal, time becomes the stabilizer. I want you to understand that fear around investing often comes from uncertainty. Questions like, what if I lose money? What if I make the wrong decision? And listen, those are valid questions. But historically, one of the most important factors in investing success has been time in the market, not timing the market. Markets rise and fall. That's normal. But over longer periods, they have historically trended upwards. The key is understanding that short term fluctuations do not always reflect long term outcomes. And I know I promised three tools, but let me give you a bonus tool. Tool number four, navigating fear and understanding the language of investing. Here, let's talk honestly for a moment. Many of us don't avoid investing because we don't have the money. We avoid it because it feels unfamiliar. And that unfamiliar feeling often brings a feeling or fear of being unsafe. When we step into something new, especially something involving money, the fear of making a mistake can feel overwhelming. Trust me, that's a human response. But clarity often reduces fear. So let's simplify some common terms. Stock means ownership in a company. Portfolio is your collection of investments. Diversification is the act of spreading your investments across different areas to reduce risk. Index fund is a group of investments bundled together to track a section of the market. Return is the profit or loss on your investment. My friends, you do not need to know everything to begin learning. You only need to become familiar enough to reduce hesitation. And here's the most important part, you're not expected to be perfect, but you are expected to be informed. Let's dive into a real world scenario. Imagine a professional. We'll call her Danielle. Danielle works full time and earns a steady income. She's very responsible, pays her bills on time, and even saves a little each month. But for years, her savings have simply sat in a traditional account earning minimal interest. She's heard about investing before, but every time she considered it, the same thoughts came up. I don't know enough. What if I lose my money? Or I'll look into it later. So she waited. One day, Danielle decides to approach things differently. Instead of trying to understand everything at once, she focused in on a little bit of awareness. So she started by contributing a small percentage of her income into her employer's retirement account, especially after realizing her company offers a match. Now that's her first shift. She's no longer just earning money, she's beginning to participate in ownership. And a lot of us don't look at or think about our 401k as investing or ownership, but it is. The company that you belong to more successful that they are with the match that they offer, if they offer a match to your contribution, is just free money off of the hard work that the company is gaining through your employment. So why not take advantage of that? If you put your 6% in, which is pre taxed, which means it's money that goes into the 401k before you even see it. Because oftentimes, once we see the money, we already have something to do with that money. But this comes pre tax, which helps you with your taxes and changes, oftentimes for a lot of people, can change your tax bracket. But if you put in 6% of whatever your pay is and your company matches it with another 6%, then that money, time over time, begins to grow, accrue, and is accessible there for you. As long as you're with the company, as long as you are monitoring your 401k, and I'll also add in, because people often ask me, well, what happens if I leave the company? Your 401k is your 401k. The company match may no longer happen, but the money that you have saved over time, you now make a decision what you want to do with it. You can either cash it out, which comes with a large percentage of tax off the top because you'll have to pay the IRS, or you can roll it over into other instruments that your bank or your broker can help you monitor or navigate where to park that money now. But the point is, you don't lose that money. The money is yours. So why not try it? Why not start it? Why not do something with it? And this is not just for people that are looking to retire from their company after 30, 40, 50 years. This is for anyone. Look into your company, and even if they do not do a match, begin to invest in that 401k. And if you move from job to job or locations or whatever, this money will follow you. So that's just a little bit of help and sourcing out and kind of thinking about your 401k in a different manner. The next step that Danielle did was she opened a simple investment account and began contributing a small, consistent amount monthly into a broad market index fund. Remember that savings that I said that she does every month? And so instead of parking that savings into or that money into a savings account that accrues minimal interest, she now decided that she was going to move that money into that broad market index fund. Nothing aggressive, nothing overwhelming, just consistent. She's proven over time that she's able to save that money into her savings account, so it doesn't really impact what's happening in her day to day life. She just moved it into a better position so that that money can make money for her. And over time, something interesting happens. Danielle becomes more comfortable. She begins to understand the language a lot better. And then she starts asking better questions. Later, she started exploring the crowdfunding platform. She invests a small amount into a business that she believed in, something that spoke to her and what she believed in. She invested a small amount, fully aware of the risk, but now more informed to make that decision intentionally. Danielle didn't make dramatic leaps. She made a series of small, informed shifts, and those shifts changed her relationship with her own money. She went from fear to understanding into participation. And that's what investing looks like in real life. We are currently seeing a increase in conversations around financial independence. especially amongst our younger generations. Movements like FIRE, financial independence, retire early, and increased access to digital investing platforms have made financial education more accessible than ever. However, remember, increased access must be equally paired with responsible understanding. Speculation is not investing, ownership is. So, for this week, I want you to consider three actions. First, review whether your employer offers a retirement account, such as a 401k or similar programs. Second, research whether your company offers matching contributions. Many professionals leave thousands of dollars unclaimed each year simply because they do not participate. And third, begin the basics of index investing, which allows individuals to invest in broad sections of the market rather than attempting to pick individual stocks. All I'm saying, my friends, is you do not need to rush, but awareness, building your awareness, is a critical step one. Ask yourself this: am I only earning money, or am I building ownership in the systems that generate wealth? Because those are two very different paths. As we close today's conversation, remember this: earning is not just about money, it's about access. It is about ownership. It's about the ability to make informed choices in a world that's constantly shifting. You do not have to panic. You do not have to react emotionally, but you do have to remain aware. A better way of earning exists so that we can think clearly, move strategically, and build systems that protect our futures, not just for ourselves, but for the generations watching how we respond to global changes. If today's conversation challenged you, sit with it. If it stretched you, research it. If it empowered you, apply it. And if you're ready to explore practical tools, real opportunities, and an ecosystem designed to support professionals and companies navigating this modern economy, I invite you to continue the journey with us and invite a few friends along, because earning differently is not rebellion, it is evolution. Until next time, my friends, stay informed, stay prepared, and mostly stay in ownership of your choice.